So mark this day down, 20th of January 2017. You know, will we look back on this day and with hindsight realize it was the beginning of the end? Or will we look back on this day and in a few years' time and have to stuff our face full of humble pie? Only time will tell. So we have a certain Mr. Donald Trump hitting the White House today, and as he thinks he's going to be tremendous, whether he turns out to be, who the hell knows, to be quite honest. It's a unique times, people. Unique times, interesting times to live in, interesting times to trade through. I mean, that's for sure. I mean, you know, forget about the politics of it all. If you're a trader, this guy's good. If you're interested in short-term volatility, you know, if you're interested in uncertainty about the future driving, sharp market movements, then this guy is good for business. Whether he's going to be good for the greater populations of this world will obviously time will tell. I'll come back and talk about this. He obviously hits the White House today. His inauguration speech, he gets sworn in and officially begins his job. So we will come back to that. First of all, just looking at the markets, we'll have a quick review of yesterday, ECB day. Just for now, just going to go 5-minute chart on the DAX, because we had a decent pop to the upside just over the last 5 minutes, really. We'd been languishing down, quite messily chopping around that low point we had last night for the DAX around 7:30 there, just chopping around that area for the last half an hour. But all of a sudden, we've got propelled to the upside, and we've just broken through the pivot level, which had been a really good resistance right at the open. So equities on the up, testing 11,600 here for the DAX. You can see my S&P chart on the right. I'll just draw a line in here. This is on a 1 hour time frame, and again the S&P did make a new high for the session there, but really just only by a couple of ticks, just testing that overnight high. The DAX looks a little bit more interested on the upside. In response to that, you can see my gold chart top right pulling lower, so touch of risk on here. Gold pulling back to the pivot level, which is the low of the day. Bunds bottom left chart edging to the downside. Not massive moves these, but a tiny hint. Oil new highs for the session, so a tiny little hint of risk appetite. It hasn't really come off any news flow. We haven't had any headlines drop that would lead us to explain this. Just seems to be a little bit of buying here in the first hour of European trade. There's a bit of a rumour in the mix that the retail sales data from the UK at 9:30 might be good, but I wouldn't pay too much attention to that at this point. Sterling hasn't had too much of a move here. If sterling was making new highs, then all right, fine, it might be something to be aware of, but for now, just little skirmishes at the start of the session. So let's look at let's talk ECB first, and maybe let's just bring the euro into play here and look at the euro versus the dollar and look at what happened yesterday afternoon. We had that step lower where we moved from the 107 handle down to 106.11. Double whammy here in that sort of 30-minute period, or you might say a couple of hours on this chart, but really most of that move was done in 30 minutes, and that was because we had some very strong US economic data, so a bit of dollar strength, as well as then Draghi talking. The dollar strength, the data was fully fed data, best reading for 4 years. You had some strong housing numbers. You also had a very strong jobless claims number, which was the second best reading in 40 years. So, decent data from the US. Then Draghi, look where the euro is now, and that pretty much sums it up. Right now as I speak, 106.87 is pretty much where we were trading before Draghi's press conference yesterday. So, we're almost, well, what are we, 20, well, not even 19 hours later, and then markets aren't phased. We're unchanged, and that pretty much sums it up, because he didn't really say anything. I mean, at the time, you could have spun it in a very marginally hawkish way, whereby, his comments surrounding inflation were perhaps not quite as hawkish as we expected, in that he didn't really change his view on it. This is, and let me just very quickly bring up an inflation chart. Sorry, 1 second. I'm going to bring up a Eurozone inflation chart, because what's happened in the Eurozone, as is the case really across the world, is this. Inflation has ticked up and made a substantial jump to the upside in the month of December. So this is like multi-year highs here for inflation. And so I think some investors were expecting Draghi to at least acknowledge the fact that, look, inflation is ticking higher, and therefore, this might lead central bankers to start having that on their radar and to become a little bit more hawkish with their comments, because they need to prepare the market for the idea that they might start to deliver some more hawkish policy in the near term if inflation carries on ramping up at this rate. It's kind of what investors were thinking, at least for him to acknowledge that, hang on, all right, inflation is on the up. But he didn't really. He said, actually, this is transitory. This is about oil. I spoke about this yesterday prior to the ECB press conference, so I'm not going to cover it again, but this is really an oil-related move. If you look at inflation at the core, take out oil, then you can see it's actually pretty flat. So he's saying, look, inflation's not moving higher, actually. And so that was taken slightly dovishly. So we got some euro weakness, which has been entirely reversed now, as you can see. And thinking about the other assets, I mean, the DAX here is trading. Let me just go to a 60-minute chart. The DAX is trading, well, the DAX traded higher during that press conference. Not much, there was hardly anything in it, really, off the slightly dovish angle, but really we're not too far off where we were beforehand. You can see we're trading not too. Today's range is pretty much the ranges we were seeing back on the 16th of January. The S&P's, trading in a very. I mean, U.S. equities generally continue to have their quietest period ever. This is the time where, if I just looked at the S&P on a daily chart, we have been flat for a long time now. Check this out on the top of this chart, obviously ramping higher off the post-election euphoria that Trump's going to deliver some mega corporate tax cuts. And the S&P 6% higher since the election. But look, really, that doesn't tell the story. The S&P has gone nowhere for 5 weeks. We are absolutely flatline here for 5 weeks. No volatility, incredibly low intraday ranges. Sorry, forgot to change my screenshot. Apologies. Here, let me just show you that. Let me make this a little bit bigger. Here we go. So this is the S&P chart. I'm looking at ramp higher off the election. That election rally really ended, I would say, on the 9th of December. Ever since then, nowhere, nothing. We've gone up and down, obviously, but really we're going nowhere fast. So, you could say this is a market that is, priced in quite an optimistic view of what Trump can do. And now it's like, oh, hang on a minute. There are some risks to that. Hang on, let's just wait and see, shall we? And this market is in a classic wait and see mode. And we're not going to have to wait much longer, because Trump begins work today. Well, really, it's next week, I would say. Monday next week is first kind of a day proper. This today is more about celebrating his inauguration. And he's not going to do, there's certain celebratory events over the weekend. Monday is really day one. So we'll see what he's got. So I'll come on to Trump in a minute. But yeah, one thing about today, it is perhaps a market event, his inauguration speech, that is. And the reason is because apparently he wrote it. So if he's in charge of writing his speeches, then strap yourselves in. We might get some comments that might move markets. Right, so let's just talk about what's happened already today. We've had some data in already. Now, this is quite an interesting chart. It's looking at German PPI, producer price, factory gate inflation. And what's obviously interesting about it is the right-hand bar, which has printed at 1%. Okay, so annualized PPI, producer price inflation, for December of 2016, plus 1%, making this, as you can see, the biggest reading since 2012. And as you can see, we've had a 4-year deflation cycle at the factory gate that's now turned positive. This was as expected, though. We were expecting 1% and we got 1%. And this is definitely about a switch and a turn in energy and also metal prices that's finally kind of led to actually prices appreciating when German producers are buying their raw components. So that's something interesting. It wasn't really market moving because it's what we were expecting. Let's think about other stuff that's already happened today. So we've had a whole bunch of Chinese data, and perhaps first and foremost, we've had Chinese GDP data for Q4 of 2016. So this was announced overnight, and this came in at 6.8%. So let me just get the timing on that. This was announced at 2 a.m. this morning. So 6.8%, which was 0.1% higher than expected. We were expecting 6.7%, but it's just ticked slightly higher. Now, if we've also got the full year reading now. So the full GDP growth for 2016, these are first preliminary readings, they could be revised, is that the Chinese economy grew at 6.7% in 2016, which is pretty much bang in the middle of the government's range. I think they gave us a range of, was it 6.5% to 7%? So 6.7 landing that right in the middle. This is, I mean, Chinese stocks were marginally higher off this, but there's not. I wouldn't say there's too much of interest in here. If we just scroll down, let's put this in perspective, because I guess the headline you might see from this is that annualized growth of 6.7% in 2016 is officially the slowest year of growth for China since 1990. Okay, which actually isn't on this chart, annoyingly. This is the FT's chart, but in 1990, or indeed 1989, and then 1990, the kind of Tiananmen Square, and then the international sanctions that followed it led China's economy to sharply move lower, but that's not on this chart, annoyingly. Anyway, you can see where we are. It's just to say, we've had growth in China. You can see in Q2 2007, 14.9%. Go back to 1993, Q1, 15.4%. On average, if you take the last 30 years, you got a growth rate of about 10% on average. And then you start seeing readings of 6.7, lowest reading for 26 years. You could make a sensational kind of headline out of that in a kind of negative way, but it's not negative. It's inevitable. You've got Chinese growth trending lower. This will absolutely continue. This low point we had in the crisis, Q1 2009, 6.2% growth. We will absolutely see Chinese growth move below that before the end of this decade. Okay, we've only got 4 more years. I guess 3 more years. 3 more full years, and I would say probably by 2019, you're going to get a growth rate that's down at around 6%, which may well move below that dip. So anyway, this is just looking at the long-term view. If we just move down and look at something that's a little bit more current, and this is a chart that's looking at Chinese foreign reserves. And the interesting thing about this chart is obviously it's driven sharply lower. It's gone from $4 trillion back in 2014, now down to actually at 3 trillion, putting it at the lowest it's been since 2011. This is all about, and when you get Trump this afternoon, whether he's going to I don't know how he's going to play this inauguration speech, but whether he's going to call China an FX manipulator in his speech, he could well do. I mean, he's said it many, many times in recent months. Whether he chooses to repeat it in this speech today, I don't know. But he calls China an FX manipulator. Ironically, in the last few months where he's been calling China that, China have been aggressively trying to stop their weakening currency. They're really worried about this. The yuan is declining in value as money kind of gets extracted from the country, and the central bank are trying to take their dollar reserves here, take dollars, switch it up and buy yuan to try and force the yuan rate back higher. So this is why these foreign reserves are declining, and that picked up speed, you can see, as we went into the back end of 2016. So they're trying to prop up their currency's value at this point. So this is just interesting to see that their dollar reserves are going to dip below 3 trillion as we go into this year. So that's China. We had some other data from China. Retail sales in line, it's 10.4%. So that's on an annualized basis. In December 2016, retail sales in China was 10.4% higher than it was the year before. Industrial production was also in line at 6% growth on the year. So this data out of China was pretty much in line, I would say. Nothing too much to move markets by. There's been some other stuff going on. A bit of attention on Yellen again in the press this morning. Yellen's it's been argued that she's been making some more hawkish comments of late. So this was a comment that the press are running with again this morning. I think that allowing the economy to run markedly and persistently hot would be risky and unwise. So I would say this is a hawkish comment. She's basically implying that if you allow the economy to run hot, that means allow inflation to remain above target for a period of time, then it's risky, implying that they're going to hike rates. She said the other day, you should expect multiple hikes this year, 2017. So I think it was last week, they actually started to talk about stopping the reinvesting of maturing assets. This is actually beginning to think about naturally allowing the money supply to gradually start to decline. So you've definitely had a bit of a slightly hawkish turn on Fed speak, I would say, recently. So in terms of what does the US government, the new US government, think about that? Well, it's a ridiculously confused message. Trump said on Tuesday, or went Monday night, he said the dollar's too strong, which did indeed lead to some dollar weakness on Tuesday. But then he's just signed up Munchin as his Treasury Secretary, and he said yesterday, we like dollar strength. So I don't know whose message to believe, really, and whether these guys have even had a chat yet about their dollar strategy, because one thinks one thing and the other thinks the exact opposite. So it's a little bit confusing. Here's a chart looking at IBM. So IBM had their earnings. It is earnings season. I mean, I think it's got virtually zero press, and that's because the current addiction is politics. And so actually this earnings season has just been as if it hasn't happened. And of course today Trump's doing his inauguration speech, so the press is all over it. But we do have earnings coming in. IBM, look at IBM's share price. Hang on, I've got a chart here. This is the chart this is a 1 minute chart of IBM's share price after they announced earnings. They beat expectations on both profit and revenue, which set the share price on the upside for 3 minutes. Then it stabilized. Then it sold off to finish down on the day, which kind of sums things up. If you look at IBM's revenue chart, I appreciate this isn't very clear, but basically what it tells you is their revenue declined again, and that is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 15, 16, 17, 18, 19. That is 19 quarters of consecutive revenue decline. That's every quarter they're making less money than the quarter before. So this is a pretty impressive run in a bad way. But this is all about the old school computing giants getting overtaken by their younger upstart brothers who are more in line with the the modern tech and the social media of it all. Anyway, earnings season is ongoing, by the way, but nobody really cares. This is looking at that dollar. This is looking at Trump then. So let's talk a bit about Trump's inauguration. We're not quite sure on timings. There's been reported two different things, but it seems that at 2:30 p.m. London time, he's going to get sworn in. So this is where he gets his Bible out. He's actually using two Bibles, apparently. Traditionally, the president is sworn in using Abraham Lincoln's Bible, but Trump's decided he wants to use his own. So he's going to use two. Anyway, this happens at 2:30. There's then some debate as to whether he immediately starts speaking. So that means he delivers his inauguration speech straight away. Because so Deutsche Bank are saying 2:30, but then the BBC are kind of saying more like 5 p.m. So look, we'll.
Swearing's at 4:30.
Ah, right, okay. So
midday, it's 11:30 swearing, 12 o'clock speech.
Right, so Deutsche are wrong. So it's 5 p.m. speech, is that right? So all right, it looks like 5 p.m. London time speech. Okay, we'll give you an update on that and try and 100% clarify that. But that looks to be the case. So 5 p.m. This is just a chart of the Dow Jones. I've really covered this by looking at the S&P chart, just to say the red box stocks have gone nowhere for over a month now. Gone nowhere at the very highest point they've ever traded, mind. But we'll see. They do look a bit vulnerable, I would say, to a break lower if Trump chooses to be his usual self. If it's anything like his press conference a couple of weeks ago, then it's going to be stock negative. We'll see. This is quite an interesting graphic. Just make it a bit bigger here. Hang on. This is just looking at, well, firstly Obama, and during their time in the White House, how did equities perform? This is looking at global equities, MSCI emerging markets, S&P 500, and then total global, MSCI World, ex-US though. Okay, so unfortunately for Obama, well, actually, before we look at this chart, let's look at the table below. This is looking at all the presidents back over the last 80-odd years. Back to Hoover, back in 1929, who managed tried to manage the economy through the Depression. So what we've got here is two columns. Column number one, how did the equity market perform in between the 3 months where the president got elected in the election through to inauguration? Okay, so we've just had that period for Trump, and this is how did the S&P perform. The second column is how did it perform in the entire time that president was in office. And as you'd expect, generally speaking, equities went up. That's because they're in office for a medium to long term, and history has shown that in the medium to long term, equities have moved higher. There are notable exceptions. Obviously, Hoover had an absolute shocker because of the Depression, but look at his upside. We obviously got a big bounce after the election, but in the end we had an elongated, shocking recession. Stocks down 30% in his time. Other than that, you've only got Nixon minus 2.5, and then actually George W. And unfortunately for George W. Bush, he only notched up a negative print because equities collapsed just before he finished. Because check out Obama's unbelievable stat. Between the 3 months, and it's not even 3 months, it's 2.5 months between election and inauguration, equities dropped 65%. This is, of course, the financial crisis. Quite unbelievable. But that unfortunately for Bush, meant that he notched up the biggest negative reading since Hoover. Obviously, Trump's going to come in. Phenomenal reading on the first column for Trump, 36.1%. But obviously where we go in the longer run, I think it's going to be very difficult for him. Anybody who had a very large positive, well, actually Eisenhower had a big similar number and actually notched up a decent reading. looking at the longer average, notched up a decent reading. So we'll see. Anyway, it's just interesting longer term. Here's Obama's stats with regards to the S&P sectors and then some of the other assets. So 2008 election to the 2016 election. So his time in office, including, that's from election to election. His time in office, that takes out that period between November 2008 to January 29 that was so unbelievably bad for markets. So let's look at that right-hand column. Generally, he's been good for markets because every single market on this list has gone up. So that's including all your bond markets, gold, oil, you name it, it's gone up. Technology sectors, pretty broad-based move. There's not too much divergence there. So it's been a fairly, mid-cycle has been a large part of Obama's election time, this very elongated mid-cycle, which actually is a period where you don't get too much divergence between equity sectors. All right, anyway, just of interest. This chart's interesting just because we've actually seen quite a divergence here, I would say. Check out the yellow emerging market chart. And it's quite amazing. Emerging markets have gone nowhere for 6 years. This has been a flat, range-bound market for 6 years now. In that 6-year period, the S&P's pretty much done nothing but go up. So you've had a notable divergence where you've had a very positive US market and a very flat emerging market. Is this set to continue? We will see, obviously. I would say there is one key risk to emerging markets from the Trump event, and that's Trumpflation, and it's the idea that Trump is going to drive a sharp increase in the dollar's value. This can come from a successful implementation of a fiscal stimulus package and a corporation tax cut, driving growth and inflation, and the Fed has to hike more. That'll drive dollar strength. You could also get a short-term blip higher in the dollar if Trump delivers a policy whereby corporations are given a short-term window to repatriate cash that they're hoarding internationally abroad, because they don't want to bring this cash back home. Like Apple, for example, have got, I forget the number now, what is it, like $250 billion, I think it is. Apple have got about $250 billion abroad, and they don't want to bring it home because they get taxed at a 33% corporation tax rate. So they're waiting, and what Bush has done in the past, another Republican president, has said to these companies, right, bring your money home, we'll only tax you 15%. Bring it home, you've got a short-term period, and what this might lead to is a big blip higher in dollar strength, because this will be money, this will be euros and pounds and whatever else currency, buying dollars as these companies bring their money home. This might have a very destabilizing effect on the emerging market space, because dollar strength, a lot of emerging market companies have dollar-denominated debt. And if the dollar rallies hard, even if it's for the short term, it could send these companies off the edge. So there is a risk to emerging markets here. So we'll see. Anyway, quickly moving on, a few other stats to show you, a few other interesting charts. These are just longer term charts thinking about US presidents. This is the GDP growth rate as they entered office. So Trump's got a pretty decent start. Well, certainly Obama is the president, quite unique. He started with US GDP at its worst reading. There was no other president that hit the White House with the economy in a worse state. That is a fact. So Bush looks quite rosy here. In terms of joining the White House with GDP at a decent level. S&P 500, Trump is joining office at a record high. And nobody's done that. You've got to go back to Bill Clinton and then maybe Ronald Reagan. But certainly Obama had a shocker here in terms of when he started. Bush started just after the dot-com bubble top. But Trump starting on an all-time high. Here's the unemployment rate. Trump starting with unemployment pretty much at a record low. It's not quite at a record low, but certainly as presidencies go, he's starting at a very healthy point in time. This is looking at the labour force participation rate, which is very low. So it's at a 50-year low here, or maybe perhaps not 50 years, 40-year low, which isn't good. Inflation rate, pretty much record ever low. And then finally, share of US income going to the top 1% is right up there at pretty much a record high. So you've got inequality at its peak, which is half the reason why he got elected, I guess. Middle America getting squeezed, and a lot of Trump's policy is protectionist to try and give these middle Americans their jobs back. So let's quickly move on. So his speech, it's going to be at 5 p.m. We think could be market moving. Who knows? He's written it apparently, so it could contain anything. We shall see. But the press is going to be all over this. This is a global event. All right, just looking at the data before that, UK retail sales coming. This is at 9:30, so just over 10 minutes time. There's rumours it's better than expected. We got an expectation that it's going to come in at a massive 7.2% on an annualised basis. I mean, that seems like a massive reading. Let me just have a very quick look at the chart of that on an annualised basis. Hang on a second. Let me just find that chart. Retail sales year on year, that's got to be a record. Oh wow, okay. October was 7.5. Let's just look at a 10-year because it did step high. Yeah, on an annualized basis, we are up here at a decade. Well, let's go to maximum. This chart takes me back now, 2 decades here, and we're kind of top end of the range. This is as good as it ever really gets. Just after let's say 2003, 2002, 2003, it was up here. But so this is very punchy when you're looking at a longer term. On the month-on-month basis, where's my calendar gone? Month-on-month basis, we're looking for it to be negative, ironically. So despite the fact that annualized reading looks phenomenal, month-on-month is looking to slide slightly, seasonally adjusted. Otherwise, not too much of any note, I'm afraid, on the data front. Nothing. Okay, retail sales are added at the UK, and that's it. None of the rest of this. There's a load of Canadian stuff that is not of interest for us. Just note that Yellen's speaking yet again tonight at 7 p.m. Talking on the economic outlook and the conduct of monetary policy, but she's had a few comments already this week. It's not likely. And anyway, we're going to be right in the middle of the Trump event, so that's going to be irrelevant. Harker's talking at 2 o'clock. He's normally neutral. So yeah, here we got 5 o'clock on this timetable. Trump is going to start speaking. Williams, Coa, and so on. Really, it's just all about Trump later on. Okay, just finish very quickly. Back on the chart. So we had that touch of risk on as I started this briefing. It's kind of calmed down a bit now. The DAX has pulled slightly lower. As has crude oil dipping back to test the previous high as support around about 52.36. The Bund is still hanging around its lows. So a quiet-ish start. Little bit of risk appetite, which hasn't lasted. But really, today's session, I'd say, is going to be pretty quiet as we drift into the main event, which isn't until 5 p.m. All right, guys. Enjoy your session. Enjoy your weekends. Thanks a lot.